Today, you're going to learn how to earn market-like interest on your personal and retirement accounts by using a clever and guaranteed way that will remove the risk so you never suffer losses in those accounts. Hi, everyone, and welcome to today's call. My name is Mark Maiewski, and I'm a lifestyle protection specialist and tax planning consultant in Asheboro, North Carolina. And one of the pressing topics I frequently receive from clients is how can I grow my long-term money without playing the market and its associated costs and risks? So, are you finding it harder to save and prepare for retirement? The stock market is up and down. It's hard to earn consistent returns every year. And listen, taxes are on sale now, but it's inevitable they will be going up. So I'm always searching for ways to reach the upside of the market with no risk for my clients, in addition to helping them save on taxes. Well, the good news for you today is I'm very excited to bring to you our very special guest, Stephen Gardner. And the reason I asked Stephen to join us is due to his diligent research that he has revealed to help families and investors find safe alternatives to the stock market. Plus, I know of no one else that understands these principles of wealth better than Stephen. Currently, he is a best-selling author of 6 financial books. He's also an independent financial columnist for Jim Cramer's investment news site, The Street, which has 30 million monthly readers. Stephen, welcome to the call.
Hey, thank you, Mark. I'm happy to be on the call today with you and your clients.
Great. Hey, man, you've been busy. You just finished book number 6. And for those of you listening, Stephen's newest book is Taming Wall Street. What a great title. So tell us, Stephen, how did you come up with the title of that book, and why did you write this book?
Oh, well, I came up with the title because these proprietary platforms that we're going to look at today, they earn like Wall Street. They mimic the indexes that are on Wall Street, but they can't lose. You can never slide backwards once you lock in your account value. And so it ends up being a tamer version of Wall Street. And so Taming Wall Street, I've always been a fan of the Chronicles of Narnia and Aslan. And as I went through some difficult times in my life a few years ago, there was this image of a lion that would just give me courage. And so that ended up being the cover of the book, was this lion. And, you know, there's wolves on Wall Street, and there's bull markets, and there's bear markets. And so what I want to do is show people how to be a lion, take control of their finances, educate them on good, sound financial principles. You know, protect your money from losses. Be careful of the fees that you're being charged without even knowing about it in most cases. So my background is education. I come from a long family of educators, and my passion is money. And so before I got as busy as I am now, I used to work with about 500 families a year. And most of my clients are on the wealthier end. Over 50% of my clients are doctors of some kind. But as I worked with these families, I also worked with many families that were struggling. And even these wealthy doctors and business owners, they're paying high fees. They're losing money when the markets dip, or even more money when they just drop out from under you without even realizing what's going on. And so as you read the book, the title, Taming Wall Street, becomes very obvious. But in a nutshell, I show people how to take advantage of the gains of the market and earn like the stock market. The groups we work with, however, have figured out how to eliminate the losses, and the groups that back them will guarantee that you won't lose your money, and you won't have to give back past years. I mean, who cares if your money grows by 5% and 8% and 10% only to have a 20% loss that takes you back to where you were, and now you're out 3 years, right? So you get the power of the stock market and the American economy, but we remove the losses. Okay, so again, you get a tamer version of the same powerful growth engine. And, Mark, everybody wants to capture the ups of the stock market, and they want to remove the losses. And so that's what my book shows people how to do. So why did I write the book? This was actually my favorite book to write. I'm very passionate about the two major topics that it covers. And I've been involved in insurance and retirement planning since 2003. But around 2007, I was introduced to a way of saving and growing my money that was a total paradigm shift. It kind of messed with my mind on how to save and invest and take control of your money. And the strategy allowed me to legally avoid paying future taxes, which was huge. It allowed me to retain liquid access to my money in case of an emergency or an investment opportunity that came along, or to help me recover the money I normally spend on major purchases like cars and other real estate investments. It's a strategy that allows you to earn interest in two places at the same time. And so the end result, when people do it correctly, is they end up with more money. So it's pretty cool. So that's what the first half of the book is about. And then the second half, which is what you wanted to cover today with your clients that are on this call, is where you can grow larger sums of money, like an IRA or a Roth or a SEP IRA or an old 401k. Maybe you've changed jobs and have some old 401k money. Or maybe you just have cash sitting at the bank earning a pitiful 1% or less, and you don't want to tie it up in a 5-year CD earning 2 or 3% because that doesn't even keep up with inflation, right? And so these growth-focused annuities earn like the stock market, but the insurance companies will guarantee that you won't lose your money or have your account values slide backwards after they lock in. And I found, Mark, that most people would rather consistently earn 5, 6, 7% without the risk of loss than try to go for the 7 to 9% that Wall Street continues to market and brag about, even though they're not really getting it. And run the risk of losing their money. And so I think most people just don't know where. It's like the Goldilocks principle, right? It's not too hot and it's not too cold. It's just right there in the middle. But that's what people need, is that consistent growth. And so it's these growth-focused annuities that I want to shed light on and explain the advantages and disadvantages.
Well, the book is great. I mean, I've gone through it several times. I've shared it with many clients. Now, you've thrown out some pretty bold statements, so I wonder if you can kind of elaborate on them with me. First, you said that these are guaranteed, so let's talk about that. And then you also mentioned that they can have market-like gains when the stock market is up, but not lose at all like the market when it drops. And the third thing I think you mentioned was that consistent earnings. So can we cover those first, and then I have some common questions I received that we can cover during the remainder of the teleconference. So what do you mean when you say guaranteed? Because I know that's a word Wall Street is not allowed to use.
Yeah, Wall Street, in fact, there's very few. It's only the insurance world that can really use the word guarantee. And that is based on, that has nothing to do with the FDIC that your bank is going to offer. What it means is the insurance company guarantees that they will meet their financial obligations based on their ability to pay their claims. Now, the groups that we work with, they've been in business for over 100 years. And so they have a very good reputation for keeping that promise. And these guys are so highly regulated. I mean, their accounts are being audited every 30 days. Some of these guys, they have reputations to maintain. One of the groups I work with, they've had an A rating for 90 years in a row. And so these insurance companies are incredibly conservative. When it comes to Wall Street, they take major risks because every 90 days they have what are called these phone calls where they get the investors on the line. And every 90 days, they've got to post gains or show something big, something magical is going to happen on the horizon, right? the insurance companies think 50 years in the future. So they don't play in the same risk pools. They don't have the same pressure that Wall Street has. But they're also not trying to hit home runs every time. They feel like if they can consistently get a base hit, they're going to drive in more wins than the person that's always swinging for the fences. And so what they mean by that, and we'll get a little bit more detailed as we talk about how to get market-like returns, but once your account locks in, then that becomes your new baseline. So I'll give you an example. Let's say that you have $100,000 and the account goes up by 8%. Well, now you have $108,000. That would then do what's called an annual reset, and it would lock in. Now, they don't guarantee what you're going to earn in year two. None of us know that, right? But from now on, going forward, $108,000 is the new locked-in rate. That's what they now are saying. We guarantee you won't go below that amount unless you take money out to live on. And so this is based on the claims-paying ability of these A-rated, 100-year-old companies that have been keeping their promises during the Great Depression, during World War I, World War II, the Great Recession, the dot-com bubble, the inflation that we saw in the 80s. They kept their promises during all of this. So that's what I mean when I say the word guarantee, and that once that money locks in, it's contractual that it won't go below that account value.
Well, I've had clients in these programs during the Great Recession when the market dropped by a total of 39%, and not one of them lost money. So I can speak from personal experience with my own clients.
Yeah, most people know this, but until it's pointed out, they don't think about it. But since the year 2000, just in the millennium, the stock market has lost over 39% of Americans' wealth twice. Not once, but twice, Mark. I mean, think about your baby boomer friends and clients and the seniors and the younger people that you're working with. Think how much more money they would have if they didn't lose during these times. I mean, none of us have a crystal ball. No one can tell you when the next market drop will be or how much it will be. But I can tell you with total confidence that the stock market will drop again in the future. And in fact, Jack Bogle, the founder of Vanguard, predicted that we will see 2 major drops in the next decade. And so people have got to protect their money from these drops that are inevitably going to happen. Warren Buffett, his company Berkshire Hathaway, took a 28% loss on Kraft this year. And in his annual letter to investors, he told them that another major drop is coming and that losses are just part of the game. Well, I can tell you, Mark, that losses are only part of the game if you choose to allow them to be part of your game. And my clients have removed losses completely and chosen to play in the safe zone while still being able to get a good rate of return on their money.
Well, those are some really good points, and I remember reading those articles, and I was just shocked when I heard how much Buffett had lost, because he's the guy that everybody looks toward. So I've been in the business for over 20 years, and my clients have suffered through the losses of 39% or more since 2000. So I know exactly what you're talking about. So let's talk about how these programs earn like the market. Now, I know your book goes into greater detail and even shows some real life results, but how will this work for my clients?
Okay, that's a good question. So how do they get market-like returns but not market-like losses? First, I just want to remind your clients on this call that insurance companies don't think or behave like Wall Street. Okay, they look into the future differently. They have longer time horizons than Wall Street. If Wall Street doesn't perform, people leave and go to something else. They bounce around all the time. That's why I can confidently tell you that if Wall Street says you can get 8 to 12%, and people are just not getting that because they are bouncing around too much, right? So the pressure for high gains quickly leads Wall Street to make decisions that end up in losses, sometimes big losses. They are short-sighted. They play the short game, whereas insurance companies play the long game. So they have most of their money in corporate bonds and dividend-paying bonds. Some of it's inside of commercial real estate, and a small amount is inside of the stock market. What they are good at is buying options that pay a higher amount when they do well, but don't lose if they perform poorly. So these options have a leveraged payout if the market goes in the direction that they believe it will go. With the growth-focused annuities that I describe in the book, the clients link their money to an index and earn based on how that index performs. But let me be clear, a client's money is never placed directly in the index. The index performance only tells the insurance company how much to credit your account when it grows. So for example, there's a growth-focused annuity out there that pays 70% of whatever the S&P 500 earns for the year. So your account value, if the S&P 500 went up by 12%, you would earn 8.4%, and that amount of money would then be locked in, never to go below that new amount, right? But so for simplicity's sake, let's say that you had 100,000, your money just grew by 108,000. It has grown to 108,400, right? But let's say that the following year the stock market dropped by 12%. The person directly in the stock market just lost 12%. So now their account value is down to 98,560. So while they were bragging about getting the 12% and you only earned the 8.4%, they are now 2 years into it, less than what they had at the beginning, and you're still sitting at 108,400. Pretty neat, right?
Yeah, when not losing money, when the market tanks is incredible.
Oh, yeah, absolutely. And so, there could be years where being directly in the stock market could be to your advantage. And most years the market is going to grow, and you're going to be able to take advantage of that. But when it drops, it's just so devastating. And so that's what this really is protecting against. You're basically counting on the fact that there's going to be losses, and you're protecting in advance, right? So when the market goes up, everybody wishes they were in the market. I'm telling you, from talking to 500 families a year, everybody wishes they were in the market, right? It's fear of missing out. But when the stock market drops, everyone wishes that they were as far away from the market as they could be. And this program allows clients to take advantage of that upside growth and eliminate the downside risk. Now, here's something to really think about. I want your clients to pay close attention to this. In the past 40 years, there have been 3 major drops. I'm not talking about small drops like 10 to 15%, even though I know those are big. There have been too many of those to mention, so I just want to focus on the 3 major drops, right? So in the mid-'80s, the market dropped 22% in a single day. People can Google Black Monday. Imagine losing nearly a quarter of all your money tomorrow. In the mid-'90s, in the mid-'90s, there was the savings and loan crisis, and the market dropped like a rock. Around 2000, there was the dot-com bubble when the market dropped 3 years in a row, 3 years of double-digit losses back-to-back. And then, actually, I guess there were 4 major drops, right? Because so everybody listening in on this teleconference right now certainly lived through the Great Recession when the stock market dropped by 39%, right? So, I mean, if you look back over time, that's 4 major drops, right? You know, I don't know how old most people listening to this call are, but if you will be alive in retirement for the next 20 to 30 years, My question is, how do you plan to survive? Can your portfolio handle market drops like these? Would market drops like this damage or completely ruin your retirement, right? I mean, how many people do you know that thought they were rich in 2007 and getting ready to retire, and now they're still working because of the devastation, right? So it's one thing to endure the ups and downs of Wall Street when you're younger and while you're still working. It's an entirely different landscape when you are 55, 65, 75. Drops in your later years can ruin your retirement, significantly lower your income that you depend on, or make you dependent on your adult children to take care of you. And Mark, I'm sure in the last 5 or more years, you've met hundreds of people that had to delay their retirement because of 2008, or had to continue to work with no retirement date in sight, or worse, they were in retirement and had to go back to work. I'm sure that you've come across people like that.
Yeah, and I believe it's the biggest fear for those who are getting close to retirement or in that phase of life. I mean, trying to time the market is never a good strategy either.
Yeah, I mean, survey after survey shows that the number one fear among baby boomers and seniors is not death. It's running out of money, right? Because you hit a certain age where it's very hard to be hired. You certainly wouldn't make enough to take care of yourself. And so you get one shot at retirement, and so you just have to do it right. So, you know, these losses can be prevented, but only by getting your money away from direct participation in Wall Street. If people want to guarantee that they will have money and income during retirement, then they need to work with programs that have guarantees. If they want to speculate, what's that?
I said that makes total sense. Yep.
Yeah, but if they want to speculate on Wall Street, then they're just going to have to take responsibility for the consequences that come with Wall Street, those major drops. So again, if you want to guarantee you're going to have money and income, then you've got to have your money inside of programs with guarantees.
And I've seen it way too many times, but it also leads me to, it's the main reason behind my desire to educate clients on this way of protecting and growing their money so that they understand fully, I mean, how to do it and why to do it.
Yeah, I mean, I'm on the same mission. My book will show people a few other ways to protect and grow their money in programs with a time commitment as short as 5 years and as long as 9 years. The book will show you actual earnings, and when you do the math, you can see how during bad times of the economy and good times, these programs have earned between 5 to 8%, depending on the year. You know, and I often think, at what rate of return am I willing to risk my money? At what difference of return am I willing to risk my money?
Well, that's an interesting question. So what do you mean exactly by that?
Okay. So what I mean is, if you could earn an average of 6% with no risk, at what difference of a higher return am I willing to risk my money? So, for example, Wall Street is constantly beating their marketing drum, that 8% returns, right? Yet an unbiased research firm like Dalbar shows that the average investor in mutual funds actually earns closer to 3.5% because of fees and losses and bouncing around. They don't get these returns. So is it worth leaving the realm of safety, earning 5 to 6%, to enter the realm of risky for the extra 1 to 2%? I mean, it's an extra 1 to 2% maybe versus a locked-in consistent return, right? So is it worth exposing yourself and your retirement account to these losses? And I think everyone should ask themselves this question, especially as they get into retirement. Is it worth the excitement of a little higher return and the stress of potential market loss for that little of an increase, a potential increase?
Right. Well, and that's a really great thought exercise. It would be one thing if it were 6% safe versus 12 or 16 with risk, but when you're talking about a few percentage points in gain with the potential for double-digit losses, I mean, it really begs the question on whether it's worth the risk. So let's before we wrap this up, let's cover a few common myths about annuities so people have correct information, and then we'll go ahead and wrap up the call, okay?
Okay. One that I hear is annuities are expensive and have too many fees. This is true if you're dealing with what's called a variable annuity, which invests your money in mutual funds. So these contracts that we use, they have no upfront commission that's eating into your money, and they don't have an annual fee. So 100% of your money from day one starts going to work for you. In some cases, there's even an occasional bonus. It just depends on the program, right? So the fees are not an issue. If there are fees, let's say someone wanted to throw on a rider, that has to be disclosed up front, and it's all put in writing. But the growth-focused annuities I'm talking about, there is no annual fee. There is no commission that eats into the money, and there is no tax that eats when you're doing an apples-to-apples transfer, okay? Another one is – oh, go ahead.
I was going to say, let me just give you a quick story about that, because I had a client that owned a variable annuity. It had shown significant growth for like 3 years, according to the, quote, returns. But when we examined this a little bit closer, it was discovered that she was paying 1.7% for an insurance expense that would never end in there and would continue as the account grew. And that was on top of the other 0.83% in administrative expenses that were also incurred. So then on top of that, you review the turnover ratio, which shows that because these are into mutual funds, it was determined that the 8 funds that they were using, it turned over 109.88% each year. So every time something gets turned over, there's another expense. And where do you think that expense is coming out of? Is it coming out of the mutual fund company, or is it coming out of the client's money?
Yeah, everything is always taken out of the client's back end.
Exactly. This is just why we want people to understand what fees are being charged within this type of annuity. But what we're talking about in your growth annuities, it doesn't have any of these kind of fees.
Yeah, the growth-focused annuities that I'm talking about don't have any fees unless you add on a rider. And I don't do that. I know that there are people that add that, but again, it must be disclosed, and it's typically less than 1%. But again, the programs that I'm talking about, they operate on a spread, not on an annual fee. Okay. So another one that I hear is my money will be tied up. I won't have liquidity. Almost every one of these growth-focused annuities that we're talking about allow you access to 10% of your money. You can take more than that, but there is a small penalty for doing that simply because they've taken your money and put it to work, and if they have to sell or back out of a contract early, they do take a financial hit on that, and so they do pass that on. But everybody that I have helped get into these programs, they understand I'm in this for 5 years, I'm in this for 7 years, I'm in this for 9 years. They're not looking to go away. And if your money is protected and it's going to grow, you don't want to walk away anyway, right? So you do have access to your money. The biggest one that I hear that I just absolutely we have to clear this up is when I die with my annuity, the insurance company keeps all of my money. So this only occurs when you outlive all the money you initially invested and the gains earned, right? So you would have to burn through all of your money. Now, if someone turns on a stream of income from that, they still have to pay you even if you've run out of money. But the only way that they're keeping the money is if you've already spent all of the money. So what I mean is, let's say that somebody puts in $1 million, right? And they die a week later. Their family gets the full $1 million. Or let's say that they put in $100,000, and 5 years from now it's grown to $135,000, and they die. Their family gets the $135,000. So it's an absolute myth, and they don't keep the money. And anybody that has a concern about that, we can show you in writing the death benefit and what your money will pay out, right? So. Another one that I hear, Mark, maybe you've heard this, is if I move money to an annuity, I'm going to start with less than what I moved over. Again, the annuities that we're talking about, that's not the case. That may be true for a variable annuity that's buying into front-loaded mutual funds with fees. But again, the growth-focused annuities that we're talking about, 100% of your money gets moved over. So if you move 100,000, all 100,000 participates, right? Okay. Now, two disadvantages to moving money to these growth-focused annuities. First, you don't receive all of the market returns in some of the strategies, right? So sometimes you'll earn between 45 to 70% of whatever the S&P 500 does, right? Other times, I do have access on these proprietary platforms. I have access to programs that can earn 100%, and it operates on a spread. So it really just depends on the strategy you choose. There's also multi-year strategies where you can have an even higher participation rate than 100% because you're locking your money in for, let's say, a 2-year period or a 3-year or a 5-year period. Because they're not doing trades all the time, they save a significant amount of money, and they pass that on to you in the form of a higher participation rate, right? If you ask for all of your money back before the end of the term, again, the insurance company has put your money to work, and so there would be a surrender charge for them to take your money back out of that, right? It's similar to a CD. If you walk away from a CD early, there's a penalty, right? So now there are bad annuities out there. There are annuities that are good that I still wouldn't touch. And so the ones that we're talking about, I believe, are the best of the best. They don't have the fees. They have the guarantees. They have the good track record. We have access to the top money managers in the world because these companies can afford them, and yet there's not these annual fees to get access to these high-end managers, right? So pretty neat that way. And then last thing, people always assume that banks are a safe place to keep their money. I recently heard a statistic regarding the number of bank failures in this country since the year 2000. Any guesses on how many banks have failed since the beginning of the millennium?
Well, I would hope there wouldn't be 100, but I have no idea.
Well, it's actually 553 banks.
Wow.
And if you had assets, at the bank above the FDIC insurance of $250,000, 1 in 10 people got back 100%. In the same 19-year span, you don't see that kind of failure rate with the insurance companies. That's again because these companies, for the amount of liability they have more assets in reserve, right? And so you think about who do you want to park your money with, and yet I just recently read, Mark, that there's over $9 trillion parked safely inside of bank products. But you and I both know those bank products have pitiful earnings. None of them are keeping up with inflation. And yet people are worried about where to grow their money. And so what they do is they go, okay, I'm not making it. I'm not going to make it inside of a bank product. I've got to leave the realm of safety, and they go into the risk of the stock market. Now, remember, I asked the question, at what rate are you willing to leave? Now, if with these growth-focused annuities you could get 5, 6, 7%, you're leaving the realm of safety to make maybe 1%. It's simply not worth it. But if you've got your money in a bank and it's earning 0.5 and you could maybe earn 8, can you see why people leave the realm of safety at 0.5% to go for 8?
Mm-hmm.
That's why people. Yeah, that's why people are going back into the market even though they don't want to. It's because they don't know about the program in the middle. They don't know about the safety with the potential for gains, and that's why we're trying to educate people, right? I'll give you another example. 401k thrift plans for employees of the Federal Reserve, the people that run the money of the country. They have 22,000 employees. 75% of all of the money that the Federal Reserve has for their employees is inside these annuity contracts. It's not at the banks, and it's not on Wall Street. It's in these annuity contracts. The Federal Reserve, 22,000 employees. They're not even doing the banks or Wall Street. I mean, that is like such an indicator of very intelligent people when it comes to macro and microeconomics, running an economy, the power of the dollar, and where do they go? They're going with these insurance companies.
Mm-hmm. Man, that's really good stuff. Hey, we've gone over a lot of time for this that we had planned for the call, but hey, I really, really appreciate you taking the time to educate my clients on this incredible tool and really whet their appetite on how it could benefit them. So can you just give us a quick recap of why you and your clients love the concept, and then we'll sign off.
Yes, yeah, and thank you, Mark, for having me on again. So the book is going to, give a better education to people than what you and I could cover here in 30 or 40 minutes. It's going to show real life examples, and if somebody wants to work with you or with myself, we would certainly build out customized numbers, show you the published earnings from the companies, their rating as far as safety, how long they've been in business. We will put everything on the table so that people can make an educated decision. I know people are tired of losing money. We just went through this at the end of 2018. Some people lost between 10 and 15%, and it came very, very quickly right before Christmas, right? And people don't want to worry about when is the next correction coming. Are we going to, slump into a recession? Is there going to be another drop? We know that the markets will drop. If you're going to live another 20, 30, 40 years, just know that these are absolutely coming. And you can choose if you want that to be a part of your game, like Warren Buffett said, or if you want to remove it from your game, like I'm showing you, right? And again, I think people want to know that their money is going to grow and that it's not going to slide backwards in value when the market drops. I think people like the idea of partnering with an insurance group that's been in business for over 100 years, that has more assets than liabilities, that has a track record of keeping promises, even when things got really hard for our country. So I think these are the main reasons, if I were to recap, is just the safety, the guarantees, and the continued ability to get the growth that they need in order to live on their money during retirement.
Beautiful. Well, thank you again for taking time out of your busy schedule to speak with me and my clients today. So if someone wanted to get more information, how do they go about doing that with you?
Okay. Well, so anyone listening to this call today, just for tuning in, I want to send you a free copy of my new book, Taming Wall Street. It'll go through this in detail. If you go to yourbridgeplan.com and click on the Work With Me button, it'll just ask for your name and address, and then my assistant will get that out in the mail to you. So yourbridgeplan.com. They're going to learn a lot more going through the book, and I'm happy to get on and do a free consultation and do those custom numbers. As you know, Mark, I am passionate about this stuff. I am on a mission to change America, one family at a time, as I know that you are. People can also reach out to me if they don't want to go through the website. They can reach me toll-free at 888-638-0080. It's a recording where you can request the call, so you don't have to talk to anybody there. But yeah, that would be, I think, the next step would be, let's get you educated, and then you can make an educated decision once you understand this and can see some customized numbers.
Perfect. Stephen, thank you again for your time and the generous offer.
Hey, thank you very much, Mark. It's my pleasure. Have a good rest of your day. Bye-bye.
See ya. Bye.